One of my rules of thumb for investing is to be able to explain what we're investing in. Think about the bond market. There's about $2 trillion in bond market ETFs in the US. The two largest are the Vanguard Total Bond Market ETF, BND, and the iShares Aggregate Bond ETF, AGG. They invest in a way that replicates the Bloomberg Aggregate Bond Index. Let's take a look at what makes up that index. Here we have $29 trillion that make up the US Aggregate Bond Index, and the largest percentage is US Treasuries, about 40%. Now that's up from 25%. The second largest component is US mortgage-backed securities. These are mortgages backed by bonds, about 25%. US corporate debt, investment grades, about 25%. But the allocations change over time. As US national debt has increased, the US Treasury has had to issue more Treasury bonds. So now US Treasuries have gone from 25% of the total bond market to 40%, a $10 trillion increase in the past 15 years. Now let's look at the number of bonds. It's astounding how many bonds are outstanding. There's almost 14,000 bonds that make up the US bond market, and the largest is investment grade, corporate investment grade, about 8,000 bonds. There's about 1,000 mortgage-backed securities, and just under 300 US Treasury bonds. Now, with so many corporate bonds outstanding, that's where ETFs really shine, because ETFs have made corporate bonds more liquid as part of the process for creating and redeeming ETF shares and keeping their price in line with the net asset value. And more bonds in the corporate bond space, about 40% of those bonds can trade electronically now rather than being done over the phone with dealers. So the bond market has changed over time. ETFs have made bonds trading easier, investing easier, but one of the big trends is as the national debt has grown, it's become an ever larger percentage of the bond market that we track when we invest in bond ETFs. So which bond ETFs are you investing in, and are you aware of how things have changed over time?